All right, everyone, welcome to Fundamental Fridays, episode 2. So I had a really interesting week trading in the markets, and I just finished doing a video for my members breaking down the trades that we took, and I want to show you guys exactly what fundamentally drove the markets this week as well, because I entered a few trades with my members, and I got some screenshots sent through today from the members. Okay, this guy called Shane, he followed one of my trades, made £450 profit today. Josh, another member, £825 profit this week. We had other members making 1,000, 1,300. Other members making, who's my best performing member this week, £5,320 profit made this week following my trade. So the members send me their trades. So what I want to do is I'm basically going to break down what happened this week. So it was a very interesting week because remember the week before, stocks crashed, Bitcoin crashed. Okay, the dollar got very weak because of the US tipping towards a recession, and I touched on it in the last episode. This week, the markets rebounded, and this week we had very important data that came out that basically pushed away the market's fears of a US recession, which is why the markets crashed the previous week. So I'm going to break it down for you, and I'll show you some of the trades I got into this week with my members, explaining why fundamentally, what's the next economic data we have to look out for, where the market's likely to move next. And I think you'll find this video very interesting for this episode. So let's dive in. Fundamental Fridays, episode 2. Let's see what we can expect. All right, everyone. Well, welcome to Fundamental Fridays, episode 2. We're going to break down this week's markets because we saw a rebound after last week's market turmoil. Okay, remember last week we saw the S&P 500 tumble 7%. We saw Bitcoin, okay, fall aggressively at exactly the same time, down 25%, okay? We saw the Japanese yen get very strong. I did cover this in the first episode of Fundamental Fridays, but fundamentally, what happened was the US economic data was pointing towards the economy going into a recession, okay? And this was because last week, Friday, the US jobs data was not what the Federal Reserve wanted to see. The Fed 2 days previously at the Fed interest rate decision said to the markets, we feel like we've got inflation under control. And you can see this here. This is our macro spreadsheet looking at the US economy. Inflation is down to 3.2% this week, okay? But before last week, okay, the jobs data, the Fed said we got inflation under control. At that time, it was 3%, 3.3%, coming closer towards the central bank's 2% target. Core inflation on the PCE is around 2.6%. Headline inflation 2.5. Okay, so getting towards 2%. And the Fed said, listen, inflation's under control, but we're worried about the unemployment rate because the Fed has hoped that their higher interest rates since COVID and the war in Ukraine caused energy prices and inflation all around the world, that they would squeeze consumers because as people's mortgage, credit cards, car loans, student debt payments go up, they've got less disposable income to spend, driving down the demand for goods and services. Companies, obviously now they're earning less profits because people can't spend as much because they're higher interest payments. Then they're going to start to let go of workers to save money, paying all these salaries to all these employers that they've been holding on to because the US economy has been booming since COVID, okay? So the Fed wanted to see a little bit of unemployment because it helps get inflation down. Why? Think about it. Companies earn less money, they let go of workers, save wages, they can lower prices on the shop floor to attract consumers back in because they're paying less, okay? But the unemployment rate jumped too much than the markets were expecting. And the unemployment rate's gone from 3.7 to 4.3, so around 0.5%, which doesn't seem like a lot, but when you've got a population of 300 million people, that's millions of jobs. And what do you need jobs to keep growing the economy? You need people to have a job, to be spending money to drive growth, okay? So that's why the markets got spooked last week. That caused a sell-off. Now this week, the markets rebounded. Now the reason behind that is because the inflation data this week came out as the markets wanted to see. Headline inflation went from 3% down to 3.2%, okay? Core inflation went from 3.3 down to 3.2. Good, it's coming towards the central bank's target. This is why the markets are having a sigh of relief that the interest rates can come down slowly because inflation's on its way down. Now that's very good for the markets because lower interest rates boost stock markets historically, okay? Because when people have more money to spend, because their interest payments go down, when the central bank's slashing rates, what do they go do? They spend money. Who benefits? Companies. Earnings of businesses go up, right? So this week we had inflation data came down, which was good. And then we had retail sales data that came out positive in America, which showed that the consumer is still spending. So it brought away the fears of a recession. And that's why the markets jumped up aggressively and we even gapped higher on the retail sales data. Okay, now just remember, stocks and Bitcoin, they move with the bond market, right? So what, as you can clearly see here, the beautiful correlation, if you understand how these two markets move together, as interest rates on 10-year government bonds go up, which is the benchmark, very important interest rate, because everyone's mortgage, credit cards, car loans, student debt payments are pegged above the 10-year government bond. Hence why, when the rates started to go up in March 2022, when the Fed was raising rates, that's why the stock market is going down. As soon as the 10-year government bond peaks and starts to decline, that's why stock markets, you'll see over here, have a period where they run higher again. And as soon as the 10-year government bond starts to take off here, look what happened. Stock markets go down. And when the 10-year government bond interest rate goes down, as you can clearly see from here, all the way to where we are today, that's why the stock markets have rallied all the way up during this whole period of time. Why is this important? Well, just remember, if everyone's interest payments are pegged to the 10-year government bond interest rate, well, this explains when the interest rates go up, stocks go down on lower earnings because people can't spend as much. When interest rates declining, that's why stocks go up, because people can spend more because their interest payments are going down. Okay, as soon as the interest rate goes back up again, stocks go down. And when it goes down since October last year, that's why stocks have boomed. And if you understand the correlation between Bitcoin and stocks, well, then you understand exactly why Bitcoin goes down when stocks go down. Bitcoin goes up when stocks go up, as you can clearly see here, at this period here. And then when we had this period when stocks go down, Bitcoin goes down. And then as stocks have rallied higher, Bitcoin's rallied higher. They move together. So the key point to take away is the reason why I took a trade with my members in the Bitcoin markets. Okay, look, you can see here on August the 9th, I said to my members, I've moved my stop loss to 58,000 to lock in a profit because we got into a trade just before. Okay, we bought Bitcoin here around 57. So we got into Bitcoin literally around here. And we held this trade up. We rolled our stop loss up. Train came down, happy days, we made money because we'd already been in a trade and we locked in a profit. I also bought the S&P 500 with my VIP members, okay, this week. Why? Because as the markets are betting on rate cuts because inflation's coming down, it's pushing up stocks again. As long as you got inflation falling and the consumer's still spending, so the economy's still growing. What is a growing economy? Growth in earnings. What is GDP? Gross domestic product. It's just the value of all the earnings added together. So if consumers are still spending, companies are still earning. Stocks keep going higher. That's why we entered into an S&P 500 trade this week. And look, you can see the members sending me trades. We also sold USD JPY, as you can clearly see over here, which is a currency trade I'll go into in a minute. But look, members have been pulling in amazing profits, okay? $450, pounds, sorry, 825, following the same trades, okay? So what we need to remember is this. At the moment, inflation in America is coming down. Yes, perfect. There's a worry in the markets that the unemployment rate can go up too quickly and it can cause the Fed to have to cut rates aggressively, which is what the markets are betting on. Here are the rate cut expectations. September, October, November, December, January, March, May, July, November. Look, sharp rate cuts are expected, but that's good for stocks. That's good for crypto. Why? Because I've just shown you it's the interest rate on the 10-year government bond is going to be going down, which it does. Because remember, the 10-year government bond is just the short-term interest rate the Federal Reserve sets in America affects long-term bonds. Why? Because if you're borrowing money to the US government over a 10-year period, you obviously want more interest to protect you from the unknown level of inflation over 10 years. No one knows where inflation is going to be in 10 years. So as the central bank's interest rate goes down, so does the 10-year government bond interest rate go down. Hence why, as the interest rate and government bonds have been going lower since the markets are predicting these rate cuts, that's giving stocks the room to rally. That's why I bought the S&P with my members. That's why we bought Bitcoin, okay? And that's why we're selling the US dollar. So just remember, in the currency markets, interest rates drive currencies. So look, you can see here, when the interest rate and government bonds in America was going up, so was USD JPY. When interest rates in America started to go down, so does USD JPY. Soon as the 10-year government bond interest rate goes up, so does USD JPY. Look, you can see on the right-hand side, as soon as the interest rate goes down, so does USD JPY. It goes up, so does USD JPY. And you can see here that USD JPY is rolling over now because markets are betting on interest rate cuts. And it's all down to the overnight carry trade. Go have a look at the video I posted on my channel. I break it down, right? So I've been selling this currency pair with my members, understanding that the dollar's long-term trend has come to an end because interest rates have hit their peak and they're coming lower in America. Okay, so we can get some trades on there. I also closed a trade with my members in a profit, Aussie dollar, US dollar. Okay, you can see over here, close trade with my members. If I show you, this week, where is that trade we closed? Here we go. Aussie dollar, US dollar, close my trade. Members made profits on this as well. So all these trades I'm showing you with the members, here you go, some of the profits the members have taken. The Bitcoin, Aussie dollar, US dollar. Here we go. Some members making £1,000, dollars, £5,000. All these members are taking these trades. Here you go, some of the Bitcoin trades. Member made 3,400. So all these trades were taken, it's all fundamentals. Now the fundamentals are always going to drive the markets. And the fundamentals right now are telling you that the US economy is slowing down. It's still growing, but it's slowing. So the Fed has to save the day, has to cut rates. Interest rate cuts boost markets. When it boosted markets, that's your opportunity to get into these trades. All right. Now, there are some divergences happening right now. The reason I bought US dollar, Aussie dollar, if you can see, a lot of people don't really understand the correlation between this. When stock markets crash here, Aussie dollar, US dollar goes down. As soon as stock markets rise, Aussie dollar, US dollar rise. Why? Because the Aussie dollar, US dollar is an exchange rate that follows the stock markets, because Australia sells commodities like iron ore, right? And iron ore is tied to economic growth. If the economy is growing, iron ore exports are growing from Australia, the currency is in more demand. If the stock markets are crashing because there's fears of a recession, the iron ore price is going down. Fear of a recession means less commodities are being bought, okay? For manufacturing, for building, whatever. So there's some trades that we can take. So if the stock markets keep rallying higher, the markets are betting on rate cuts. And remember, the markets are not betting on rate cuts from Australia right now. Look, they may be predicting one next year, April, but by then the Fed's already cutting like 3-4 times. So the interest rate difference between Australia and America will favor the Aussie dollar. If you watch the video on the overnight carry trade, I do break this down in a lot of detail. Okay, so that narrowing of interest rates was why I bought the Aussie dollar, to get into that trade. Okay, so fundamentally, we should be looking at lower interest rates in America, weakens the dollar, boost stock markets, boost Bitcoin, and boost gold. Gold moves alongside stocks and crypto. If you don't know, now you know. Okay, so look, you can see over here, I'll just show you again, just to give you a really good illustration. When stocks were falling back in 2022, when the Fed was raising interest rates, look at gold at the same time, gold was falling. And remember how I showed you stocks and Bitcoin was moving up at the same time? Look at gold. It moves up with stocks and Bitcoin at the same time. And look, you see over here, when stocks go down, because it was the interest rate that was going up, and I showed you in the bond market, that's when gold goes down. And look, notice how Bitcoin, gold, stocks all rise at the same time. So all you need to know is that interest rates on government bonds are the key driver, and that's all we got to focus on. That's the key. So moving ahead, the key data we want to be focusing on: inflation, employment, wages. The Fed is always looking at wages. Now, what's really important about wages is that the central bank always talks about it, because you need wages to go lower to give companies room to cut prices. If they're paying so much in salaries, there's less room to cut prices. So they need to see wages going lower as the unemployment rate goes higher. Because clearly, companies have less people that they're holding on to, then there's more people unemployed. If there's more people unemployed, when businesses do look for workers, there's less competition between businesses because there's more people available seeking employment. So you can offer lower wages. So you're hiring less people, you're paying lower wages, gives businesses room to lower prices. That's the Fed's strategy. So we need to pay attention to inflation numbers, employment, wages, and obviously our key leading economic indicators as well right now in the markets, which 2 out of 3 are negative. That's why the markets are pricing these rate cuts. Just remember 2 things. Liquidity drives price, growth drives earnings. So liquidity is when the central bank slashes interest rates and increases the money supply. That boosts anything that could be used as an inflation hedge. Stocks, gold, Bitcoin, right? And that boosts growth, which is why stocks historically go up during lower interest rate environment, which is perfect for us right now. That's what we're expecting next month. We're in now, middle of August, September rate cut is gonna happen. So the markets are gonna be in a new bull market. And if the economy unexpectedly shows a high unemployment rate before the Fed cuts rates in September, what do you think the Fed's gonna do? Slash rates more aggressively. Liquidity drives price. Stocks are gonna go up either way. So we just gotta be in these trades now and locking in these profits. So yes, guys, look, if you wanna come and get some daily market updates for free, come and join the Telegram channel. There's a link below. If you wanna come join the VIP members and trade alongside me, the link's below. If you wanna get my online courses and really learn how to dive into macroeconomics, again, go on my website, kainsmarkets.com. The link is below. And yeah, I hope this really does add some value. Next week, we got key economic data. Watch out for the market watch video I'll be posting on a Monday, breaking down the week ahead. But yeah, man, we made some really good profits. So that's what I'm really happy about, man. Seeing the members pulling 3,000, some members making here 1,900. Look, just so many screenshots of results. Members have really done really well. £2,700. Look, these are the currency trades we took just the other week. Again, look, currency trades, 900, 1,000, 300. So yeah, guys, come get involved. Please like, comment, subscribe. Let me know what you're trading and let me know how you're seeing your outview of the markets. It'd be good to hear from you. But yeah, enjoy.